Most people pick their first bank in a rush. Maybe it is the one their family used. Maybe it is the closest branch. Maybe the offer at a college fair felt good enough. The problem is that the right bank does much more than hold your money. It quietly shapes your habits, your fees, your interest, and your safety for years. A few thoughtful minutes can change all of that. At its core, a bank is a safekeeping service for your money. You hand over your cash, the bank stores and tracks it, and you can move it in and out using cards, checks, transfers, and apps. In exchange, the bank uses your deposits to make loans elsewhere. That basic agreement is the foundation. Everything else, from fees to features, is a layer added on top. The first quality to check in any bank is safety. In most countries, deposit insurance protects ordinary balances up to a certain limit if the bank fails. Before opening any account, confirm that the institution is properly insured and regulated. This single check filters out a surprising number of risky online options that look professional but lack the basic safety net consumers depend on. Next, look at fees. Many banks earn money quietly from monthly maintenance fees, ATM fees, overdraft fees, foreign transaction fees, paper statement fees, and minimum balance fees. Each one may seem small alone, but layered together they can quietly cost more than the interest you earn. The first question to ask a new bank is not how much they pay, but how much they take. After fees, think about access. How easy is it to deposit money, withdraw cash, pay bills, and move funds in and out? A bank with deep features but a clumsy app can quietly drain your time and patience every single week. A bank with fewer branches but a smooth mobile experience may serve you much better if you rarely visit a physical location. Interest rates matter too. Many traditional banks pay almost nothing on basic savings. Online banks often pay much higher rates on similar savings accounts. If your bank pays a near zero rate, you are quietly losing buying power every year to inflation. Comparing rates once a year can be one of the highest paid small habits you build in your financial life. A common mistake is judging banks only by their advertising. Many flashy promotions involve small bonuses with strict conditions, or strong introductory rates that quietly drop after a few months. The headline number is rarely the whole story. Reading the fine print once, especially around fees, withdrawal limits, and rate changes, is what separates a thoughtful customer from a marketing target. A hidden risk is convenience that quietly costs you. A bank with a branch on every corner may feel reassuring, but if its accounts charge high fees and pay nothing on deposits, that convenience can become expensive. The right balance depends on your real habits. If you barely visit branches, you are paying a comfort tax for something you do not actually use. For many people, a useful approach is to use more than one bank. One bank may handle daily transactions, bills, and ATM access. Another may hold long-term savings at a higher interest rate. A third may exist for specific purposes such as travel or business. This separation can quietly improve organization while still keeping each account simple and clear. Customer service deserves attention. Imagine a frozen card on a weekend in another country. How quickly can a real human help you? Read reviews about average wait times, response quality, and dispute handling. A bank with great rates but unreachable support can become a serious problem at the worst possible moment. Reliability under stress is part of the value a bank provides. What beginners often misunderstand is the difference between a bank and a credit union or similar cooperative. Cooperatives are owned by their members rather than outside shareholders. They often have lower fees and better rates, although smaller technology budgets. Comparing one cooperative against your favorite traditional bank can reveal surprising differences in everyday cost. The psychology behind choosing a bank matters. Loyalty can quietly cost you money. People often stay with the same bank for decades simply because switching feels uncomfortable. Yet banks change, fees change, and your needs change. Reviewing your bank every couple of years, the same way you might review an insurance policy, is a small habit with surprisingly large long-term effects. A practical rule when choosing a new bank is to start with 3 quiet filters. First, is it properly insured and regulated? Second, are its everyday fees clearly explained and easy to avoid? Third, is its interest rate on savings reasonable, not embarrassingly low? If those 3 answers are healthy, the rest is about taste, features, and personal preference. What to avoid is opening a long list of accounts you do not use. Each unused account is a small dormant risk: forgotten subscriptions, accidental fees, or missed security updates. Most people are better served by a small number of carefully chosen accounts than by a chaotic collection of accounts opened during random bonuses or promotions over the years. A better habit is to track all of your active bank accounts in one simple list, with their fee structures, interest rates, and main purposes. Once a year, review that list. Close what you no longer use. Move savings to higher rate locations if needed. Update beneficiaries. This calm yearly audit costs almost no time and quietly protects you from many slow leaks. Over the long term, choosing the right bank or set of banks is less about any specific product and more about alignment. The right setup makes saving feel easy, spending feel intentional, and emergencies feel manageable. A bank that fights your goals will quietly slow you down. A bank that supports your goals will quietly speed up everything else you are trying to build. To summarize, choosing a bank well comes down to safety first, then fees, then interest, then access, then service, then preference. Compare options patiently. Read the basic rules of each account once before opening it. Be ready to switch when something genuinely better appears. The point is not to find a perfect bank. The point is to find a good enough setup and let it work for you. Many people are surprised how quickly an account opened in 15 minutes can serve them well for many years, simply because a few essentials were honestly checked at the start. The final takeaway is gentle. Your bank is a tool, not a relationship. It is allowed to change. So are you. The best banking setup is the one that gets out of your way while doing its job in the background. Pick consciously, review occasionally, and adjust when life shifts. A bank chosen with intention quietly compounds in your favor over many years. The right setup will feel almost invisible. Your bills clear on time, your savings grow at a fair rate, your card works when you need it, and your fees stay near zero. That quiet reliability is the real prize behind a good banking choice. Few financial decisions cost less time to make and pay back as steadily over the long run.